Welcome back to Intelligent Investment Today, the podcast concerned about all things value investment. In each episode, we consider a different topic using the tools of the trade as laid down by the investment style's founding father, Benjamin Graham. This episode will be the first in a series looking into Graham's most famous disciples, examining their early contact with Graham's teachings and outlining their investment success in the preceding years. It is only right that the first in the series should be dedicated to the person whom is by far and away value investment's most famous practitioner. We are talking, of course, about Warren Buffett. So without further ado, let's get on with it. If you haven't already done so, settle back and get prepared for another dose of value investment, Benjamin Graham style. Buffett had been just 19 years old when he'd first chanced upon The Intelligent Investor, Graham's 1949 Value Investment Bible. He had for years been hungrily devouring the business section of his local library, but up to this point nothing had really resonated with him, and he was yet to develop a solid investment style, despite having been making investments in stocks since the age of 11. Reading The Intelligent Investor provided the eureka moment that will be familiar to many reading Graham's classic for the first time. Graham quickly became Buffett's favourite author, and he read and reread the many examples of value investment in action that he found in the volume. What appealed most was that it explained in simple terms how the stock market operates, in a way that other books he had read up to this point had not. It offered a rational, mathematical approach to the valuation of stocks that was right up young Warren's street. Buffett's next stroke of luck was a classic example of a blessing in disguise. After Buffett's dreams of attending Harvard Business School were shattered after an unsuccessful interview at the university, he found himself having to come up with Plan B. It was while investigating alternatives to Harvard that by chance he stumbled upon the catalogue for Columbia Business School and instantly recognised two names that were very familiar to him: Benjamin Graham and his protege and co-author David Dodd. To him, this was a little like a Beatles fan discovering the names Lennon and McCartney as tutors at a music college. Buffett almost missed his chance, as applications had already closed by the time he stumbled upon the Columbia catalogue. But so determined was he to join his heroes that he wrote a personal letter that found its way onto David Dodd's desk. Whatever he said in that letter clearly worked, as a month later he found himself starting the new semester under the tutelage of Graham and Dodd at Columbia Business School. The course textbook was to be Security Analysis, an earlier Graham and Dodd book first published in 1934. Security Analysis was essentially the precursor to The Intelligent Investor, aimed at those with a background in finance rather than the more easily accessible follow-up. His new tutors must have been impressed and no doubt quite flattered that from the outset Buffett could practically recite the book verbatim and could quote every example included in those 700 or 800 pages. He was to appear in stark contrast to most of his classmates, therefore, who appeared bored by this mandatory class and probably had little interest in bonds and stocks. It was for this reason that the young man from Omaha was quickly to become Graham and Dodd's standout student, always being the first with his hand up to answer any question. It was not surprising that Buffett would go on to be the only student to earn an A+ in his class. After graduation, Buffett had only one ambition in mind, and that was to work for Graham's investment firm, Graham Newman. As his star student, Buffett was certain Graham would bite his hand off to obtain his services, especially as he offered to work for him for free. However, against his expectations, Graham flatly turned him down. This was not for any lack of talent, but because simply this was a time and place where the big investment banks did not hire Jews, and Graham, as a Jew himself, and with the ability only to hire very few people, Graham had a policy of hiring only fellow Jews to work for his firm, and he would not make an exception even for the very best student that had ever attended his class. Buffett was to take the rejection on the chin and was to return back home to Omaha. He decided to become a stockbroker and went to work for his father's stockbroking firm, Buffett Fork. He started his career at the family firm by selling his favourite stocks to those people most familiar to him, his relatives, college friends and roommates, as well as investing any money of his own that he could get his hands on. Buffett struggled with the day-to-day duties of being a stockbroker, however. His job was to sell on a commission basis, and he found the need to make small talk and befriend clients ill-suited to his character. He soon discovered that people failed to take the badly dressed, socially stilted 21-year-old seriously. Buffett increasingly came to despise the job and felt conflicted in the advice he was giving. While he would advise his family and friends to buy a stock and ideally hold it for 20 years, a broker is paid only every time a stock is flipped. Therefore, a stockbroker telling clients to hold on for the long term is going to find themselves out of business pretty rapidly. To be a successful broker of stocks, you are required to encourage turnover, which would mean Warren would need to give advice that went against his personal instincts as an investor. It's not difficult to understand this would clearly bother a man so concerned with matters of integrity and probity. So Buffett soon made the decision that rather than being a stock salesman, he wanted to manage people's money. This way, at least, both his and his investors' interests would be aligned. He would be on the same side as the customer. Buffett had never really given up on his ambition to work for his hero, Benjamin Graham, throughout the years working at his father's stockbroking firm. He had continued to keep in contact through letters recommending stocks to the occasional visit to New York to drop in on his old tutor. By 1954, his persistence had finally paid off, and Graham relented to make Buffett an exception to his golden rule of employing only fellow Jews. A 23-year-old Buffett was quickly put to good use at Graham's firm, scouring the Moody manuals for cigar butt companies, those selling for less than the working capital. Buffett would collate those companies meeting these requirements and present them to Graham to decide on which ones the firm would invest in. This task would prove an early example of how Buffett and his mentor's attitudes to investment would come to differ. Whilst Graham was keen to invest in as many of these below working capital businesses as possible, without too much investigation into the business's qualitative picture, in the full knowledge that a proportion would fail as investments, Buffett was much more keen to keep diversification down to a minimum and concentrate his personal holdings in the below working capital businesses that passed his tests of quality. Whilst Graham was first and foremost concerned by the desire not to lose money, achieved through large-scale diversification, Buffett's approach was to maximise his returns by investing in only the most attractive cigar butt businesses he could find, those promising the very best return. At this stage of his career at least, he was not opposed to placing all his eggs in one basket. The main difference between master and pupil at this point came down to this. While Buffett was motivated solely by the idea of becoming rich, Graham cared little for collecting wealth. His main motivation was simply the intellectual challenge of beating the market. Buffett could see that high levels of diversification may well be enough to earn a very comfortable living, but if he wanted to reach his goal of becoming a millionaire by the age of 35, then he needed to concentrate the returns in his portfolio. It is hardly surprising that Buffett flourished in his new role at Graham Newman, the role of financial analysis being much more suited to his skill set and personality than had been the job of salesman stockbroker. And within 18 months of joining, he was already being considered as a future partner in the firm. Buffett was indeed offered the opportunity to become partner in 1956. However, the situation at Graham Newman had shifted. Graham was 62 years old and decided, after beating the market by 2.5% for more than 20 years, it was his time to quit the investment business and enjoy his retirement. Buffett ultimately decided against stepping into Graham's shoes. He had joined the firm to work with Graham, and without him there seemed little point in hanging around. He hated living in New York for one thing. He also wasn't well suited to working in a partnership, especially one where he would have been the junior partner. So at the age of 26, Buffett decided to strike out with his own investment partnership, where this time he would be the boss with nobody to answer to. As well as his own stake and separate investments, the firm would allow him to take a cut of profits generated from the other partners, thus accelerating his ambition to become a millionaire. He formed Buffett Associates Limited in 1956 with just 7 partners, all of whom happened to be close family and friends. Buffett disliked the idea of having people criticise him for his portfolio's performance, so it was important to him that he only received investments from those who really believed in him and would not question him about short-term fluctuations in his stock's performance, nor condemn him should things go really awry. Buffett devised an unusual and quite risky formula to charge his partners. He would receive half the upside above a 4% threshold, but also took a quarter of the downside as well. This put him personally on the hook for an unlimited amount of portfolio losses. It also notably meant that he would actually lose money should his portfolio break even. Just try to find terms like that anywhere else. But it just goes to show how confident he was that he would deliver results for his new partners. Buffett's next big break would come as a result of the decision by Graham to close down his firm. Homer Dodge, a long-time investor in the fund, had approached Graham to recommend somebody to take on the funds that would soon be becoming available following the secession of the partnership. Graham, of course, was more than happy to recommend his young protege. Dodge gave Buffett $120,000 to invest, and a separate partnership was set up by the name of Buffett Fund Limited to manage these funds. This amount of money was an order of magnitude larger than he'd been managing for the partnership so far, containing his friends and family members. But more importantly to Buffett was that the recommendation had come from his idol, Benjamin Graham. A third, separate partnership soon followed, and before long he was managing more than $500,000 across several funds, including his own money, which he continued to invest separately to the partnerships. Buffett's reputation would continue to grow, and he continued to sweep up people who placed large sums of money with him to invest. In these early days, he still very much stuck rigidly to the Benjamin Graham school of investment, seeking out only the very cheap, even if the very cheap meant soggy cigar butts with just a single puff left. His rigid adherence to Graham's mythologies was about to be put to the test, however, when he met the next big influence in his life. We're talking about a certain Charlie Munger. It was in 1959 that Buffett met the man who would go on to rival Graham as the biggest influence on his professional life. He met Munger at the Omaha Club, a club where Omaha's big hitters would meet to socialise as well as to do business. Munger had been on town on business, and a mutual friend had been so convinced the two would get along that he set up an introduction. Up to this point, Munger, 6 years older than Buffett, and also originally a fellow Omaha native, had been practicing real estate law with a firm in California. Munger, normally a guy who likes to be the one holding court in any conversation, was so enraptured in what Buffett had to say and what he was doing with his partnerships that he was happy to let the younger man go off on one of his investment masterclasses. Munger straight away grasped the ideas of Benjamin Graham and was intrigued if he could do a similar thing to what Buffett was doing back in California. This meeting of investment soulmates would continue through almost daily phone calls long after Munger had returned home, and this conversation would continue for the next 6 decades. Buffett's partnerships continued to perform well, and by 1960 his partnership's assets leapt to almost $2 million. After producing a 46% return in 1961, by January 62, Buffett made the decision to simplify his partnerships arrangement by dissolving them all into one entity, Buffett Partnerships Limited, managing over $7 million. Another notable landmark was reached around this time. At the age of 30, Warren Buffett had become a millionaire. By this point, Munger was already beginning to influence the way Buffett did business through their regular phone calls. Munger thought that Buffett was too attached to what he considered Graham's gloomy pessimism, and thought his friend should move away from hunting out the damp and unappealing cigar butts that up to now Buffett had made a career out of. Whilst Graham was above all interested in the quantitative outlook of a business, in other words, the facts and figures around the business's finances, Munger was much more concerned about the inherent quality of a business, or the qualitative outlook. With Munger's influence, Buffett would gradually shake off his treasure-seeking instincts and begin to consider businesses that may not be cheap exactly, but that demonstrated qualities that would allow the business to grow, such as good management and any durable competitive advantages, qualities that Graham would only ever consider in a superficial way. Part of the change in Buffett's outlook as an investor must no doubt have been down to the fact that as the amount of money he had available to him to invest ballooned, he would have increasingly found it difficult to find promising homes for his cash pile. In the Graham cigar butts of the past, he increasingly needed to look further afield to the larger cap stocks that were rarely underpriced. Whilst from this point onwards Buffett would increasingly diverge from the investment style of his mentor, I believe people tend to be too quick to ascribe Buffett's change in investment style in this period as a rejection of Graham's teachings. The fact is, it should be quite easy to find suitable opportunities in cigar butt companies if your aim is to invest several $1,000,000, but opportunities in such businesses that allow the exposure to make it a worthwhile venture when it's tens or hundreds of millions or indeed billions of dollars means that you're going to have to start looking at the more reasonably valued businesses that will allow you to invest a meaningful amount. So whilst Buffett would continue to seek the sort of value opportunities as espoused by Graham, he would now, under Munger's influence, become much more of a growth-focused investor, happy to pay over the odds if a business looked particularly attractive, something Graham would have considered a far too risky proposition. Buffett's investment history and success from this point onwards is pretty well known. What was perhaps one of his final pure-play Graham-style investments was in the failing textile producer that would go on to give the name to Buffett's sprawling conglomerate, Berkshire Hathaway. This investment in a moribund industry would not go well, and perhaps cemented the idea for the short of long-term holdings that he would require going forward, that quality was the key. Over the decades, major investment successes would follow with the likes of American Express, Walt Disney, as well as a number of insurance companies. The common denominator in his stock picks from here on in was invariably quality rather than purely for cheapness. But of course, if he could have both, more the better. So where does that leave us in evaluation? There is no doubt in my mind that Warren Buffett would not have become the investor he was without the lessons imparted by Benjamin Graham. In many ways, it was a typical mentor-pupil relationship, in that it is rare that a pupil turns into a carbon copy of his or her mentor. What is typically the case, the mentor imparts the founding principles of a trade, and as the pupil goes on to master the art, begins to formulate their own style. But far from rejecting his teacher's investment approach, as some claim, Buffett still, first and foremost, considers all his investments essentially from the viewpoint of, wherever possible, underpaying for a business. However, the fact that Buffett must now hold positions of several $1,000,000,000 just to make it worth his while means that, except in the deepest throes of a bear market, de facto bargains at this level are unlikely to be numerous. This means that Buffett, most of the time, is forced to pay the going rate for the sort of businesses he would wish to hold for the long term. The sort of cigar butts in which Graham plied his trade are no longer a practical option for him. To me, it seems natural that should Buffett had kept his partnerships to a small scale, rather than creating a financial behemoth, or perhaps stuck to investing only his own funds, then his percentage returns would have been even better than is achieved at Berkshire Hathaway. We will of course never know for sure, but what we do know is that the evolution away from Graham's influence towards that of Charlie Munger was a necessary step in his quest to make his conglomerate as big as it has become. And that is all I have for you today, folks. I hope it gives you a good idea of how Benjamin Graham influenced Buffett, how his teachings created the basis of his investment success, and how Buffett's investment style has altered over the years. I do hope you've enjoyed the show. As ever, if you do feel like adding to playlists, please do so. This will ensure that you are alerted every time a new edition lands. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.